But I want you to expand on that because I think that's really, really, really important. It is absolutely something that probably is a really good fit and probably offers more stability than the stock market because, and I will throw this in there, and I love to throw this graph up when, I talked to someone the other day and we were talking about, alternative investments versus the stock market. And the person said to me, I just feel more confident in the stock market because you can't lose money. And I said, hold on, time out a second. I said, do you remember what happened during COVID? Because people lost a lot of money. And depending on when they invested, they might have lost all of their money. So
Right.
there is something to be said there. So I will pass the mic back over to you. But like that is a really important piece for people to grasp. Is it's not just for young people or people that are a little bit kind of further down their path in their career. This is actually a good opportunity for people who are further along and looking for just steady income in their retirement, because the idea here is I don't want to work anymore. I don't want to worry about this anymore. I just want to go live and enjoy the time that I have. Welcome to the Stephen Lee Thomas Show, where we provide expert advice for real estate entrepreneurs. And I'm your host, Stephen Lee Thomas. And it wasn't that long ago that I was navigating the challenges of real estate investing, learning from my mistakes, and building the business I have today. I created this show to give you simple, actionable, step-by-step strategies to help you do the same. Each week, we bring you in-depth discussions with industry leaders and professionals who share their knowledge and practical tips. So sit back, take notes, and let's dive into today's episode. 3, 2, 1. Let's go. Hi, everyone. Welcome back to the Stephen Lee Thomas Show. I'm your host, Stephen Lee Thomas. And today, my guest is Lon Welsh. And so Lon Welsh has over $100 million assets under management. He's actually, this is one of the things I love, and I'm excited to talk more about. I think a lot of you will be able to relate to this, but he actually has been able to help a lot of the people who have been active investors in the space and that have either found out it's not for them or feeling burnt out. He's actually helped them find that freedom they were looking for in the first place, which is super exciting. And he's been in this space for over 20 years. Lon, thank you so much for joining us today. How are you?
I'm fabulous. Thanks for having me.
Absolutely. Lon, where are you calling in from? What part of the world are you in?
I'm in Denver, Colorado.
In Denver, Colorado. And how is the investing market out there in Denver?
It's a little bit of a challenge. Our state legislature passed over a dozen laws over the last 3 years that were all hostile to the landlord and very friendly to the tenant. As an example, if you have a problem tenant in an apartment building who's kind of loud, smokes a lot of pot, and is irritating other people, if you decide, gosh, I'm just going to wait out this lease, I'm not going to renew him because he's chasing away good tenants. If the tenant decides they want to stay, you have to let them stay. You don't get to pick.
Really? That makes it okay. So that makes it more challenging, and I really want to explore that more. And I know that you have different asset classes that you're providing for investors, and we're going to get there more. But I always love to start and go back in time a little bit, learn a little bit more about you, because a lot of times what happens is we have some pain that we try to solve for, and that gets us to the point we're at now. So can we go
Sure.
back in time? You said you've been in this, investing for 20 years now. Can we rewind the clock a little bit, and can you give us an overview of where you started and some of those pain points and how you got to where you are now?
Yeah, before I got into real estate full time, I worked in corporate finance for a couple of years. I went back to business school, and then I worked as a strategy consultant for 8 years at Deloitte and then Accenture. So when I got out of grad school, I was filling out one of these retirement calculators, trying to figure out how much money I needed to save up to have a decent lifestyle in retirement. And these things are all predicated on taking out like maybe 4% per year of whatever you've been able to save up. So you need to save up some asinine amount of money to have a good retirement. I was looking at this saying, this is going to take a really long time, or I'm going to continue living on ramen noodles like I did as a grad student, which I don't want to do.
Can we really
So
quick? That's a super valid point right there, and a lot of people do not get this when they think about retirement. They're like, I'm just going to put money into my retirement account, and it's all going to work out for me. But you actually sat down and did the math. You came up with about 4%. So for a person to live comfortably, and I realize it's all kind of relative, but if someone wants to live comfortably in retirement and that's what their yields are going to be like, how much money does somebody need to have at that type of a yield?
Yeah, so let's do the math really quick. So if you want to have $100,000 a year, just to make the math really easy,
Hmm.
and if the safe withdrawal rate is 4%, and I'll tell you where that comes from in a second. You take 100 grand divided by 4%. I think that's about $2.5 million, right?
Uh-huh.
So if you have 2.5 million after tax and you get that 4% return, you could take out 100,000 bucks in the first year, and then the next year you'd build right out like 103,000 will go up for inflation, and like 107,000 the next year, and it'll go up a little bit. And
Hmm.
the way you calculate that safe withdrawal rate is you take the historical rate of that investment. So let's say it's stocks and bonds. Say it's 8% is what it's done over the last 50 years. That's about what it has done. You take 8%, you back out the interest, the inflation rate that you think you're going to have. So let's say it's 3, and I would take off 1% more just to be safe. So if historically you've done stocks and bonds at 8, minus 3 for inflation, minus 1 as a safety margin, you could take 4% out, and then your portfolio will grow by the appropriate amount each year that your spending power after inflation will not change during. You could be retired for 30 years. It could be a really long time.
Hmm. Hmm.
So that's how you solve for it. So if instead you're able to invest making 12% consistently, 12% minus 3 minus 1, you've got an 8% withdrawal rate. So if you want to have 100,000 a year with that 12% portfolio, you'd only need 1.25 million. So you'd have to save half as much just by getting a better investment return.
So
So
that's a
having a really good
huge
handle
golden
on that,
nugget. That's a huge golden nugget
yeah,
right there. And people don't put it in perspective. And you mentioned inflation and what's like eating your money that nobody talks about.
yep.
That's a big, big, big core concept. Okay, so I just wanted to point that out because a lot of people don't get that. There's like, I'm gonna shove my money, it's gonna make this much. If you look at what the stock market makes on average, like 8 to 10%, well, you have to that a lot of that gets eroded away and you're not left with much. So how can you invest better? So now we're gonna go back to that moment. You're like, hold on a moment. Like this math is not working. Okay, let's pick up from there.
So, I'll be the only person you've ever had on your show who said, I read Rich Dad, Poor Dad, and said, oh my gosh, there's another way to do it. It doesn't
Uh-huh.
just have to be the stock market. So I started researching real estate and said, this is what I'm going to have to do. Within a couple, I was able to fortunately get my wife on board with the idea. So we bought a 9 unit apartment building and we bought a 4 unit, probably like a year or two after we both got out of grad school. And that's how we got started. So that was in 1998, back in when there's dinosaurs and stuff.
So that's when you got started doing that, and the rest is history, right? So you got into the apartment complex, but you probably did that using some of your own money, right?
Yeah, that was entirely the money that we'd saved up. So
Okay.
I took that first 4 unit building, I converted it into condos and sold it off, and realized that the realtor made about as much money as I did. It's like, I'm just going to get my license. I couldn't find a realtor that I really liked all that much.
Okay.
I built a bunch of tools to help me understand supply, demand, by neighborhood. So I had to figure out where is the best place to buy rentals and why. And I figured, now that I built these tools, I bet there's other investors that would like to have this. Maybe I'll start a brokerage that's investor oriented. So I started a brokerage in 2006. I left my job as a consultant, or 2004 is the start date for that. So it's been 21 years. And built a brokerage called Your Castle Real Estate that I grew to be the largest independent brokerage in Colorado. We have about 750 agents. So I ran that for just about 2 decades. I sold it to a private equity fund in December of 21, right before the rates went up, and then I started Ironton Capital right after that.
And there you go. So the timing of that probably didn't make you feel real great, but you've been able to survive, and now you're in a position to thrive through that. So all right, but I want to hang out in this space a little bit more because you did that while you were working, while raising a family. That probably took a whole lot of your time, right? A lot of
Oh,
focus, a lot of energy, a lot of effort to do that.
yeah, launching a company is really all-consuming. So what I tell people who have an aspiration to start a business, especially if it's in real estate brokerage, having done that, is that you can have a team of about 15 people, and it's like having a sorority or fraternity. It's really a lot of fun. You can have a brokerage of about 100 agents, and you can actually make some money doing it. It's the valley of death in between the two. So you have to be really intentional and say, I've got a plan, and I'm going to scale, and I'm either going to stay at 15 or I got to get to 100 as fast as I can. Because in the middle, you can't afford to hire anybody. You've got all the support work to do, and you've still got to sell real estate to make a living. It's just a very uncomfortable place. So you want to get through it as fast as you can. And I think most businesses that have a high fixed cost infrastructure have got a scale issue that you've got to climb that mountain as quick as you can.
which is, to your point, is not an easy thing. And I think statistically, I could be a little bit wrong about this, but like 80% of businesses fail within the first couple of years.
That's what I've
And
always
it,
heard. Yeah,
yeah, I mean, it's tough, right? I mean, I can attest to that, having left my corporate job and working on a business and making everything stable and getting things consistent and hiring people. And like, there's a lot to it, you know, and
there is.
it's not for everyone. But there's a lot of reward for that. But you have to, like you said, you have to balance a lot of that with the family life and everything else going on. Um, but there's good news behind all of that. Not everybody has to do that amount of work to take advantage of these types of investments. So then you moved into a space where you actually were able to start helping people. And I'd like to talk about the people that you help and how they can actually invest in real estate passively. Like what does that mean? What does it even look like? So can you frame that up first? Like what are these passive investments? How does that work? And then we can, circle back around to who's really a good fit for that.
Oh, you bet. So I'll give you just a quick backstory. I've written 13 books. I'm working on number 14 right now, most of which were related to real estate investing. So I used to do for the better part of 15 years, one class after another about how to get started in real estate investing, how to evaluate a rental property, what are the elements of cash flow to improve once you own the property, et cetera. And then there are 20 people in a class, and one of them afterwards say, "Yep, Lon, I want to go buy an apartment building with you," which is great. I got another client. But 19 out of 20 would tell me, "I see the logic. It makes a lot of sense. It's certainly a lot better than the stock market, but I'm a busy physician. I do not have time to do this. I'm sorry, I can't do it."
Uh-huh.
So after hearing this for lots of years, like, I should develop a product that serves 19 people out of 20 instead of one person out of 20. I'd probably be a lot more successful. So that's what the shift to passive investing was really all about. And it kind of complemented. I've been a landlord for over 20 years now, and I'm a little bit tired of it myself. And the legal environment change in Colorado is definitely accelerating that. So what we do is we make investments sort of like in a small mutual fund of commercial buildings, so that someone who either is tired of being a landlord or maybe they're just a busy professional, they don't have time, but they see the value in having exposure to commercial real estate. We can do all of the work, the research, the monitoring, and decide when to harvest the property for you, and then we just take a share of the profits on the upside if it works out. So it's been a really, really great solution because it turns out there's a lot of people who would love to have this type of help.
Okay. So saying that a little bit different is you are doing all of the hard work, all the heavy lifting, you're finding the properties, you're doing the asset management. You're working with, if there's a property management company, whatever there's, you're doing all of that hard work, but I can come along as a busy professional who has been saving money, has money in my 401k or in the stock market, and I'm like, I clearly understand that I'm not making as much money as I would like, but I don't have the time nor the desire to go and do all those things. I can actually reach out to you and say, Lon, what do you got for me? Like what kind of investments do you have that can, outperform these other investments? That's the
Yeah,
level of service you guys are providing, right?
this is what we do. So we've got really three main products. We've got a short-term fund. It pays 8.5 or 9%, and it's really liquid, so you can get the money out quickly if you need it. That tends to be really useful. Like if you own an apartment building and you're saving up money for a roof and an elevator upgrade and maybe a parking lot repavement, those are three things you know you need to do that are pricey, but you don't know exactly when. You can
Hmm.
park the money with us, make 8.5, 9%, and then if the boiler stops working or the roof needs to be repaired on short notice, we can get the money back to you.
Okay.
We have a medium term income fund where the money's tied up for a year. Then you just need to give us 3 months notice to get the money out. So it's sort of like a CD in that regard. And it pays between 11 and 13%. Pays a dividend every quarter. So the more you invest, the higher you get paid. Sort of like a CD. The bigger CDs pay more than the smaller CDs do. And then lastly, we have a long-term investment fund in commercial real estate where we'll try to get a basket of like 30 to 40 different properties in about 10 different states,
Okay.
mostly multifamily, but a little bit of industrial and hospitality. And the goal of that is to generate about a 17% annual return. So if you put 100,000 in, we hope that we give you 100,000 back and about 90,000 profit about 5 years later. So depending on the investment horizon that you're looking at, we can mix and match. If you're selling an apartment building, you might need to put some in the medium term fund to replace the income that you were enjoying from your investment because maybe you're living off of that. And then the rest goes into the long term fund to replicate the long term investment that appreciation that you've enjoyed by having the asset. So we can synthetically recreate all that.
Okay. What are the as far as that the assets that are in you mentioned, some of the long term, but what about the short term and medium term? What are the assets you guys are acquiring that are in that fund?
So the short-term fund is comprised of about just under 300 hard money loans. So you may have some listeners that have done fix and flips, or they've had other needs where they need to borrow money on relatively short notice to get a really great opportunity in the market. So that's a portfolio run by former commercial bankers. It's about a 380, I'm sorry, $280 million fund. So we're the biggest fundraiser for that. So people who invest with us get a tiny slice of all of those mortgages. What I like about that is
Okay.
that their average loan to value is about 65%, and the borrower has to personally guarantee the loan, and they've never had to go after a borrower yet. I mean, they've certainly had their pro rata share of properties that don't pay back and they go into foreclosure, but so far the money they've made on the foreclosures has been more than sufficient to make up for what was due and all the past due fees and things like that. So that's a really great portfolio.
All
Does
right.
that make sense?
Yeah, no, that makes perfect sense. I think it's very smart. So do you also do hard money lending?
Not directly. So we partner with the firm that does it. We help to raise capital for them.
Gotcha. Okay. All right. All right. So and then that's where okay, so you're that is so okay, so that's I want to explain that a little bit. So what that would be is you would be investing, you would take your money, you would invest in that, and then that money then becomes available for that firm for their hard money loans, and then that's where you're getting it's short term, but you said it's 8 to 9%, right?
Yes, exactly.
Okay. So 8 to 9%, and that is relatively liquid.
Yeah, you'd like to have like 2 to 4 weeks of notice to get your cash
Okay.
back. So it's not an ATM, but it's pretty liquid.
Awesome. All right. And then your medium term fund, what's the asset in there or blend of assets that are in there?
This is actually my most favorite investment is medical receivables. So when you see a billboard on the side of the highway saying, "Hey, you were in a car accident, call this attorney. He's going to sue that other guy and get money for you." The patients tend to call the attorneys first before they even call a doctor. Most of them are neck injuries from colliding into the car in front of you. So the attorneys tend to pick one or two spinal specialists in a region, and they send all of those patients to those two doctors because they want to have someone who's really articulate. In case this
Uh-huh.
actually goes in front of a jury, you have to have a doctor who can really clearly explain it and be persuasive so that you can win the case. So these physicians or clinics get a deluge of these cases, and it might take 12 to 18 months before we decide if me with Geico or you with State Farm, which of us is at fault, who's going to pay this claim. So meanwhile, the physician has all these expenses they need to pay. If it's a large claim, their admin team will do all the paperwork and ride the case out. If it's a tiny claim, they'd rather just make it go away and get paid today. So our sponsor partner takes over the administration process of all of the paperwork for that claim, and we give the doctor about a third of the value. So if it's a $30,000 spinal case, we give them a check for 10 grand. We take over all the paperwork. Doctor's on to the next thing. So there's a basket of about 100 of these, and they're all cross collateralized. Our expectation is that two or three are going to prove to be fraudulent. Like, you're like a serial disaster person getting into car accidents. You're already
Uh-huh.
getting care from three other doctors. We're not going to pay you for this. And once in a blue moon, like Geico, State Farm, Allstate, they're not going to go out of business. But there's very small insurance companies too, and sometimes they become insolvent and they just can't pay. So if we've got four cases out of the 100 that don't pay, we're cross collateralized. We go after the other 96 to get paid. So nothing is foolproof, but you could screw up a whole bunch of different ways to make this work. So the important thing is that we're collecting from big insurance companies. We're not
Hmm.
collecting from consumers. And the rate at which people get into car accidents is not linked to the stock market, interest rates, who wins in office, what's going on in Ukraine. It's
Uh-huh.
independent of all that. So I have a huge amount of exposure to real estate and interest rates. So it's nice to have part of my portfolio not be correlated to the vagaries of the interest rate market.
That is fascinating. That was not the answer that I was expecting there, when you're talking about what's in that asset class. How did you even come across that as a potential asset class to set up a fund for investors?
Well, there's three of us on the investment committee. So Richard Landry is one of them. He came to us via Goldman Sachs, and he ran a $2 billion family office as the chief investment officer before joining us. And this is a relationship that he had when he was working with that large family, and said, you've got to meet these guys. They're incredible, and that's where we found it.
That is so awesome. That is it is so unique, but I love it there, and I love the diversification that brings because of where you're not really tied to, like you said, the stocks, the housing, the interest rates. That's just really just a function of like people. Like there is no getting
Mhm.
around that.
Exactly.
Yeah, like yeah, that's a really good position to be in. Okay. And then the
That's
long
actually my
term,
single biggest investment.
go ahead.
That's actually my single biggest investment. Is that fun?
Oh, I believe it. I believe it. Okay, and then the long term, you mentioned multifamily, and I think you said a couple other commercial asset classes in there. Can you hit on those again?
Yeah, we like to do mid-size, multi-tenant industrial. So there's sort of a glut of these million square foot and above distribution centers like an Amazon or a UPS would take. There's a definite shortage of very small warehouses, but it's hard to build them at scale and make any money at it. What we like to build are between like 300 and 800,000 square feet. If we have one tenant that needs that much, that's great. But more likely what happens is we have like four tenants, they might need 200, 300, 200, 100,000 each of square
Hmm.
feet. And there's a very there's a lack of this product in a lot of markets. So that's what we tend to build because it's a niche that's supply demand imbalanced right now. Another asset class we like a lot is long term hotels. So if you take a look by room night, about 19-20% of the room nights in America are extended stay. So it means you're staying for more than 7 nights. Yet at the moment, only 10% of the hotel space in America is configured for the needs of a long term guest. Primarily, what they're looking for is having a really great laundry facility on site and that they've got at least a small kitchen, ideally a functional kitchen within their guest suite. That really makes it a lot more comfortable when you're staying. And what we really love about the economy segment of the extended stay market is that it's not elective. So if you remember about this time last year, there was two hurricanes in a row that hit Tampa.
Hmm.
So they had to bring in power crews from about 12 different states to the Tampa area to rebuild the electrical grid. This is not elective work. And all these guys stay at extended stay hotels. They're probably down there for 2.5 months, putting together all the power lines again. It's fantastic. But there's a whole bunch of different demand drivers for extended stay that are all pretty reliable and not subject to the vagaries of the economic cycle. So it's a
Hmm.
segment we
Hmm.
like, and it's very supply demand imbalance. So it's one niche that we really like a lot right now. Long
Again,
answer to a short question. Sorry.
no, that's perfect. These are well, again, fascinating to hear how you've built and structured this. I think it's a great blend for anyone to be investing in because it gives you multiple layers. You've got diversification, you've got different returns, you've got different um, uh, I don't know what the right term, but like liquidity,
Yeah,
your
liquidity.
ability to your ability to take the money out, at a certain amount of time. So I think it's a fantastic opportunity. So now I'd like to step a little bit more into who are the people who are a good fit for this. A lot of times the term accredited or sophisticated gets thrown around. Can you use your like a self-directed IRA or something like that? So someone comes along, they're like, hey, like this is great. I would love to learn more. Who's a good fit for this? And I think it's also fair to say like maybe who isn't a good fit for that. Maybe it's a smaller list, but there's probably some people who maybe aren't ready for this yet.
Absolutely. So we're allowed by the Security and Exchange Commission at the SEC as our regulator to work with what's called an accredited investor. And currently that means if you're single with an income over 200,000, if you're double income with an income over 300, or if you have investable assets, just your net worth minus your house over 1 million. If any one of those three things is true, I can work with you. There's been some discussion about making those more relaxed as standards. So the SEC is supposed to give us guidance. In theory, it should have been like this summer. It hasn't happened yet,
Mm,
but it should become easier for people to become accredited going forward. I think the people for whom this is not a good fit is really understanding what is your liquidity requirement for the money, and does it appropriately match either us or somebody like us in the liquidity that we can provide to you. We don't want to get in a situation where you're pretty sure you're not going to need the money, and then 18 months from now something happens, you really do have to have it, and now you're stuck in a 5 year investment. It's going to be like kind of a headache to get out. So that's one thing. And the other is just like basically if you went to a stockbroker, said I need some help building a stock portfolio, a good one should go to you and say, tell me a little bit about your risk style. Are you comfortable with it going up? Are you going down? And then they can calibrate your risk preference and build a portfolio that's either safe or more aggressive based on what you tell them. Same thing with anything like us or people like us, that we want to make sure we pick an appropriate risk profile for you. What I could tell people is that with any given investment out of the 30 that we might pick for the commercial, long-term fund, is that we're going to have one or two stinkers. We're going to get somehow lucky. On one or two, they're going to be grand slams. We're going to have just a whole bunch of base hits. On average, it's going to blend out.
Hmm.
Sort of like if you picked a stock portfolio of 30 stocks, it'd be great if you had a bunch of NVIDIAs in there, but no one gets lucky enough to hit 30 of those.
Right. Yeah, that would be awesome if you could hit 30 of those. But again, to your point, you've got a lot of diversification in there. So you answered the question about, accredited investors, and then, what's your risk level, and how liquid are you when you need that money. And I totally agree with you on that. I think, for the people that are listening right now, if you're excited about the investments, anybody who's good and is actually has your best interest in mind, they may tell you no, and you should listen to that. If the answer is no, there's a reason why. It's just as important to, understand if you're not a good fit and why, and what that gap might be, as moving forward with it. So a lot of different strategies out there, but I appreciate your perspective on that. Another thing that came back up, I'm curious how that folds into these types of investments. Bonus depreciation 100% is back. Not everything in your portfolio is real estate that can take advantage of that. For example, the receivables on medicals. But you do have a fair amount of commercial real estate in there with depreciation. So is that something that you guys are able to blend in? And is that something that is your investors can also reduce some of what they're paying in taxes on the money that they're making?
Oh, I'm really glad you asked that. That's a really great, sophisticated question. So, something that your listeners may not know is a common investment vehicle for real estate is called a REIT, Real Estate
Hmm.
Investment Trust. For some applications, it's absolutely phenomenal. But REITs by law are not allowed to pass on depreciation losses to their investors. So, if you need depreciation, that is not going to get you there. For our long-term fund, we actually have two share classes. There's one share class that gets a slightly higher preferred return, but it gets none of the depreciation. So if you just don't need it, and a lot of busy professionals who don't have other losses to offset, that they fall in that category, or if you've got a self-directed IRA, you're not allowed to use depreciation in an IRA, so that would be
Hmm.
another situation. The higher preferred return would be better for you. Even for a minority of our investors, they're in the B share class, which gets a slightly lower pref, but it takes all of the depreciation loss. So the typical viewer for that would be you've had like this 12-unit apartment building for the last 10 years. You've had some really great appreciation. You're sort of done with being a landlord. You're going to sell it, but you don't want to do a 1031 exchange and buy yet another apartment building. You'd rather just be done. So the depreciation we can generate for you in the first year, thanks to that bonus depreciation that you talked about, dollar for dollar will offset your capital gains and your depreciation recapture. So depending on your situation, we may be able to offset all of your gains, so you don't have a tax liability. More commonly, if you've owned it for a while, and in most markets there's been so much appreciation, we won't be able to like knock out all of the tax, but we'll be able to put a really hefty dent into it. So it's a very common thing that we do for people like that is we can do a quick financial analysis and just help you figure out, all right, I've got this rental property. I've got this incredible 3.5% interest rate on it. What if I hold this for the next 10 years? What sort of wealth accumulation will my family enjoy? If I sell it and pay the taxes and put it in the stock market or our medium term income fund, what would that mean for me? And if I did it in our long term fund and I got this tax write off to offset my capital gains, what would that do? And then
Hmm.
what we can do is we can help that investor have all the facts they need to make a well-informed business decision for their family. And that's an analysis we do multiple times a week. It's really easy for us to do.
Oh, that's awesome. I think that would be very beneficial for people that are in that situation, or want to know what that would look like for them. Personally, I have a self-directed IRA. I used to invest in real estate, and I know that bonus depreciation, the whole depreciation doesn't really, I can't use it, right? Because I already get tax advantages because it's a retirement account, and I can't double dip and all that. But then I want to ask this other question, because what I find, this is really interesting to me, but what I find is a lot of people don't know that they can actually take their retirement funds. There's a couple boxes you got to check, but you can actually take retirement funds and do investments in alternative investments like this. So,
Mhm.
can you walk us through what that looks like and what that means?
Yes. So most people will use a custodian. That's just the person who owns your retirement assets for you, and they look after them for you, like a Schwab or Fidelity or Vanguard. So that's a very common uh, client custodian. They don't usually allow, because they want you to invest in the stock market with them, of course, anything alternative. But there's lots of smaller self-directed IRA custodians that will let you invest in just about anything that's legal. So if you need a referral on that, email us, and I'll be happy to give you some referrals of ones that we found that work well. Once you've got your self-directed IRA with a custodian like that, you could pick, say, our long-term fund, and then you could invest in long-term commercial real estate with us, or our medium-term income fund, or anything that was of interest to you. One super interesting. Can I take like 2 minutes on a tax strategy that people may not know about?
Ah, please. Yes, I would love it.
So something you may not know that's frustrating about a self-directed IRA or any IRA is that the money that you put in is on a pre-tax basis. So that's pretty great. But when you take the money out, it's all taxed as ordinary income. So the initial capital you put in, of course, is the salary you didn't take when you were younger. So it would be appropriate that would be taxed at an ordinary income rate. But all of the capital gains, which for most people are a much lower tax rate, are also going to be taxed at ordinary income tax rates when you take it out, which is, I find, very irritating. So something you can do is do a Roth IRA conversion. So you take your normal traditional IRA, say, I'm going to turn this into a Roth. They say that it's all income that you pay the tax on it today, and it grows tax free for all the rest of your life. It's really fantastic. The challenge, though, is it's a big tax bill all at once. Something you can do if you invest with us or someone like us in our long-term fund is, after you've been in for 12 months, if you wish, I'll refer you to a CPA who will do a valuation for your IRA. And based on the historical IRS tax court rulings, what they usually find is that there's a 25% discount if it's not marketable, because this isn't NVIDIA stock. You can't sell it tomorrow. It's tied up for 5 years. And there's usually another 25% discount if you don't have management control. So if you're in a traditional IRA and you've got Apple stock, you could decide, because you have decision rights, to sell tomorrow morning and execute on that. Once you've invested with us for 5 years, the money is stuck. You don't have managerial rights to decide when to sell. It's not worth as much if you had to sell it today because of that. So if you were getting divorced and you had to do a valuation of all of your different assets, it wouldn't be the $100,000 that you initially invested into your IRA. It'd probably end up being about half that is what the liquidation value like today would be. So what the CPA will do is do this fair market value study, tell you that your $100,000 investment is worth $50,000 if you had to sell it today. You give that to your custodian, and they mark down the value today, FMV, fair market value, to
Hmm.
50. And then you convert it to a Roth, and you're going to pay income on 50,000, not on 100. So you just cut your tax bill in half. And now it's a Roth IRA growing tax free for all the rest of your life. And when your investment with us concludes, you get the money back. You don't have to invest with us again. You can put it back in the stock market, put it in platinum futures, or whatever it is that pleases you. You've got all the decision rights. But it's a great tax management strategy very few people know about.
Yeah, actually, the first time I've heard about it. But I love the idea of that. So thank you for sharing that. Because that is one of the frustrations that I know I'm up against is, yeah, I didn't pay taxes on it, but it's over here growing, and at some point I got to pay the piper. But if there's a way to be smarter about that, absolutely, I'm interested, and I'm sure all the viewers are very interested in this as well. So, hey, Lon, this has been amazing. I've learned a ton on this. Now, you were kind enough to share a resource. I'll put it in the show notes. I'll put it in the link below the video, or anything we publish out here, we'll make it available for all the listeners. And that's like, you've got a guide available. So can you explain what that is for the listeners, a gift you're giving to them to help them out?
Yeah, I wrote a book last fall called Passive Diversified Real Estate Investing. So for those of you who have either been an active investor and you're kind of getting burned out, and you've thought about what would passive investing be like, it'll give you a whole bunch of information over and above what we talked about today. For those of you who are just busy professionals, have never been in real estate investing directly, but like the idea of diversifying your portfolio outside of stocks and bonds, this will like open you up to some other asset classes. And since this might be new to either one of those audience sets, it has a bunch of questions that you should ask a sponsor like us or people like us, just to figure out, is this the right fit for me culturally or not? And then a bunch of due diligence questions. And then as you're thinking through your financial advisor team, maybe your financial planner, your CPA, your attorney, what things could they do to help you evaluate me or someone like me to make sure this is actually the right fit for you? I've also got a chapter in there about that IRA tax management idea that I just tell you as well. So it's free and you can download it. I hope it'll be a good resource for all of you.
Yeah, awesome. So like I said, we'll make sure that we have that available for you in the show notes. Um, I want to spend just a moment. You're obviously a very bright individual. You've got the analytical mindset. There's this like buzz on the street right now of crypto and real estate. What is your take on that? Because some people are all excited. I tell you, I see people, oh my gosh, I'm going to create my own crypto platform and I'm going to make all this money. Um, I don't know that I'm convinced on that. There's some things I like about it. There's some things I think that are uh, just not going to come to fruition. But there's a lot I don't know. But clearly, I'm sure you've thought about this. What are your thoughts on crypto and real estate and what kind of disruption that may cause over the next 5 to 10 years?
What a great question. So I think it's a really good question and probably not one that I'm very authoritative in being able to answer. I don't really have a very advanced view of what crypto's strengths and weaknesses are. You probably had other guests on your show that are really experts at that. Yeah, I've had the luxury of spending 60 or 70 hours a week for a couple decades thinking about sticks and bricks, about the lowest tech investment that exists. And what I know is that people always need to have a a roof over their heads at night, and they may or may not always need to have crypto. So for us, our goal with our funds is not to get the best return. Our goal is to get a decent return with as less amount of risk and volatility as we possibly can. If you want maximum returns with maximum risk, crypto may or may not be a really good fit for that. You'll need to develop, really go in and explore that. If you're looking for, just pretty solid returns and not having to worry about sleeping at night with it, that's what we do.
Yeah, no, I definitely appreciate that perspective. I think the people that I've chatted with who are really, hey, I'm going to create this platform and we'll be able to put, deals on it and, you can invest in cash, we'll convert it into crypto and then it makes it more liquid. Immediately I'll tell you where my mind goes. And there might be people who disagree with this, but I think all of a sudden what happens is a whole lot of complexity. You add all these layers of complexity in, and what I've found is the more complexity you add, essentially is friction. And then people are like, nah, I don't need that complexity. I don't need that friction. I don't need that risk. And so I think there's people who want to get in front of this thing and think they're going to make, just millions and millions of dollars. When you're looking at it from an investment perspective, I guess back to your point, if you have a very high risk tolerance, maybe. But if you think about like really the bread and butter and the core of all of it, I think you've got to take a step back and ask yourself, am I willing to take that risk, or should I just like, you know, go with what I know works and tried and true, and we'll let some other people go through this and we'll see the scandals that pop up, and once the dust settles, maybe that's the time to move forward. That's really just kind of like my perspective on it. I know some people, like I said, some people who are like gung ho and they're like, like, I've got the greatest thing since sliced bread. I don't know that I'm there yet. So
This
just
might be an alternative thinking framework that your listeners could use, and that is if you've got a target income that you want to try to have in retirement or whatever financial goal you're aiming towards, and I need to have this many dollars, and I can take out this much per year to get the annuity amount I need each year to have a good retirement on. The question you want to ask yourself with your spouse is: it more important for me to take this $2.5 million portfolio to 5 million so I can have twice as much, or is it more important for me just to stick with the 2.5? We've agreed that would be very comfortable. Like either get there a little faster
mhm.
or get there with a higher probability of success and less risk. And if I really want to go all out and have more, the higher risk, higher return asset classes like crypto should be a larger part of your portfolio. Most of the people that I meet with have got relatively normal sort of goals. Like they want maybe like 200 grand a year in retirement. And they've got 45,000 from each spouse coming from Social Security. So they only need like 110 from everything else, and they've actually already got pretty close to the right amount saved up. So that's just a question of how do I be a responsible custodian to grow this reliably over time without taking a lot of risk. If that's the situation you're in, then we want to construct the lowest risk portfolio to get there so you don't lose any sleep over it because you've already won the game. Don't snag defeat from the jaws of victory. So for that client base, crypto may not be as good a fit, and that might just help you settle like, should I pursue this or not?
Yeah, I love that framework there. One nuance there that I heard you mention, and I think this is important to discuss, is you mentioned, a lot of your clients who are coming to you, or a portion of your clients who are coming to you, they may be pulling from Social Security. What they're looking for is, that stability in their disposable income. Now, a lot of people that I have come across now, the conversation is, I'm older. I don't want to invest in these types of assets. I'm going to put something in, very low risk stocks. But I want you to expand on that because I think that's really, really, really important. It is absolutely something that probably is a really good fit and probably offers more stability than the stock market. Because, and I will throw this in there, and I love to throw this graph up when I talked to someone the other day, and we were talking about alternative investments versus the stock market, and the person said to me, "I just feel more confident in the stock market because you can't lose money." And I said, hold on, time out a second. I said, do you remember what happened during COVID? Because people lost a lot of money. And depending on when they invested, they might have lost all of their money. So
Right.
there is something to be said there. So I will pass the mic back over to you. But like that is a really important piece for people to grasp, is it's not just for young people or people that are a little bit kind of further down their path in their career. This is actually, a good opportunity for people who are further along and looking for just steady income in their retirement. Because the idea here is, I don't want to work anymore. I don't want to worry about this anymore. I just want to go live and enjoy the time that I have.
Well, I think, the investor journey has three phases to it. There is, getting out of grad school in debt and not really having a lot of savings through the period of time where you've amassed enough wealth that you've gotten what you need for retirement. So there's the portfolio construction stage. If you're lucky, that happens maybe in your 40s, and between 40 and let's say 55 when you want to retire, you've got like this 10 or 15 years where you've got enough and it's just growing. So you don't need to take as much risk then. And then there's, I've retired and I don't want to take a lot of volatility out, and I'll be drawing some cash out of this every year as well.
Hmm.
So the way you think about the stock market might be slightly different depending on which phase of the journey that you're in, right? The stock market over the last 70 years, on average, like a stock bond portfolio, has delivered about 8% per year. I think it's phenomenal. And will the stock market be phenomenal over the next 50 years? I think the odds are very good. It will be excellent. This probably should be a part of almost everybody who's listening to this should have some part of your portfolio exposed to that. The other thing you want to be careful about is that during phase one and phase two of the journey, you're putting money in, you're not taking any money out. So when the stock market has a correction, for us, that's a time to celebrate because I can buy more stock for the same amount of money and I can build faster to whatever that end target goal is. It's not so exciting once you have retired, because if you're all stock and bond and nothing else, and if the stock market is off, let's say, what was it like? It was off 35 or 40% at one point during the COVID
Yeah.
correction, right?
Yeah.
If that's the time you've got to take off, it works exactly the opposite way against you. Like you're selling more shares proportionally than you would have anticipated for that year. And then the earnings potential for all the rest of your lifetime is going to be diminished because you kind of ate into the shares faster than you thought. You had to take money out during a downdraft. So if anything, you need to plan for there's going to be volatility in the stock market, and that's okay. That's just how it works, and have a plan to manage around it. There's a bunch of different theories of how to do that, and they've both got their pros and cons.
Again, I appreciate that perspective. Well, Lon, I appreciate you taking the time to join us today and all the education that you shared with us. What is next for you and your organization?
Well, I've got two of the guys on investment committee that are a lot younger than I am, so I think I'll be doing this for another 10 or 15 years, but they've probably got closer to 20 to 25 to go. So I hope that we'll be helping at least another full generation of people out with diversifying outside of the stock market.
Awesome. Lon, for all of the people who listen to this and they just are dying to learn more about you, your organization, how to work with you and invest with you, what is the best way for them to get a hold of you and contact you?
Yeah, so our website is Ironton Capital, so IRONPON, irontoncapital.com. And I think you've got the link in the show notes. It's irontoncapital.com/expert advice if you want to download the book on passive investing for free that we talked about. And if you want to reach me, honestly, send me a text and we'll just have like 10 minutes to talk. 303 619 0633. I was really lucky early in my career that I had a number of investment mentors that really helped me frame my thinking about how to think about real estate and get started. And I'm not as busy as everybody thinks. Like if I could spend 10 minutes with someone who's newer in their investment journey, really help them get some clear direction and set them up for the next 40 years, that's the most exciting 10 minutes I'm going to have that day. So don't feel bashful about reaching out. I'm happy to try to help you out.
It's very gracious of you, Lon. Thank you so much. I really appreciate it, and look forward to learning more about you, your organization, and looking into some of your investment opportunities here in the future. Thank you so much, Lon.
Thanks for having me. I appreciate it.
Thanks for tuning in to the Stephen Lee Thomas Show today. And if you found value in today's episode, then I have a favor to ask you. Please share it with friends, family, and anyone who might benefit from the insights we shared today. Also, don't forget to subscribe and leave a review if you enjoyed the show. And if you aren't already part of our school community, then head on over to school.com/multifamily mastery hub and join today. And again, thanks for tuning in, and I look forward to connecting with you in our school community.